February 11th, 2026, 7:30 p.m. Eastern Standard Time. The Federal Aviation Administration grounds every plane over Texas. Not weather, not maintenance. Quote, special security reasons. End quote. And in that exact same hour, silver holds $84.16, while the dollar index climbs. Now, for 247 years of monetary history, when the dollar goes up, silver goes down. That is the correlation. That is the mathematics. That is the law. Except tonight, both went up. And if you think the algorithms just glitched, then you haven't been paying attention to what the institutional players did in the 4 hours between that FAA alert and the New York close, because they didn't panic, they positioned, and you need to see what they saw. Welcome to your OG, John A.G., where we decode the economic signals Wall Street doesn't want discussed at Sunday dinner. Now, if you've lived through a few market cycles, survived a recession or two, maybe remember when gas was under $1, do me this one favor, hit that subscribe button like you'd mark an important page in a history book you know your grandkids will need to read someday. And drop a comment below. Where in this world are you watching from? Because economic storms don't respect borders, and neither does strategic awareness. Let's begin. The traders on the COMEX floor noticed it first. At exactly 7:03 p.m. Eastern Standard Time on February 11th, 2026, something happened that wasn't supposed to happen. The Federal Aviation Administration issued a ground stop. Every commercial aircraft over Texas airspace grounded, not a thunderstorm, not a technical malfunction, not a routine safety drill. The official statement read, special security reasons. And that was it. No further explanation, no press conference, no follow-up details. Just those 3 words hanging in the air like smoke from a fire no one could see. But here is where the story gets interesting. In that exact same hour, while planes sat motionless on runways across America's second largest state, silver was trading at $84.16 per ounce, and the US dollar index was climbing. Now, to anyone who doesn't follow commodity markets, this might sound like random financial noise, but to the professional traders who make their living understanding how money moves during crisis, this was a red alert. Because for 247 years, since the birth of the modern financial system, silver and the dollar have moved in opposite directions. When the dollar strengthens, silver falls. When the dollar weakens, silver rises. This is not opinion. This is not theory. This is mathematical correlation that has held true through wars, depressions, technological revolutions, and every financial crisis in American history. It is the relationship that commodity traders build their entire careers around. Until February 11th, 2026. When both went up together, the correlation broke. And when correlations that have held for centuries suddenly break, it means something fundamental has changed in the system. Within minutes of the FAA announcement, institutional order flow began flooding into the silver futures market. These were not retail investors panic buying on their phones. These were large block orders, the kind that move millions of dollars per transaction, executed by professional fund managers who had access to information the public did not. They were positioning, not panicking. By 8:45 p.m., the futures volume on silver contracts had spiked to levels normally seen only during Federal Reserve policy announcements, but there was no Fed meeting scheduled. No economic data release, no earnings reports from major mining companies, just planes on the ground in Texas, and institutional money flowing into a metal that industrial civilization cannot function without. Because here is what most people do not understand about silver. It is not just jewelry. It is not just coins that survivalists bury in their backyards. Silver is inside every smartphone, every solar panel, every electric vehicle battery, every guided missile system, every semiconductor chip that powers modern defense technology. It is the most electrically conductive metal on Earth. And right now, global inventories of physical silver are at a 12-year low. While paper contracts, the futures and derivatives that traders use to bet on silver prices without ever touching actual metal, those contracts represent 290 million ounces in short positions. This means there are institutions betting that silver prices will fall, even as physical supply disappears from warehouses. This is the disconnect. This is the tension. This is what happens when paper markets and physical reality stop agreeing with each other. And when the Federal Aviation Administration grounds planes for special security reasons on the same night, this disconnect becomes visible to anyone watching. Professional money managers start asking questions. What do they know that we don't? What event requires grounding civilian aircraft? And why is institutional capital flowing into strategic industrial metals at the exact moment communication goes dark? The analysts at major investment banks, the risk managers at pension funds, the portfolio strategists at family offices, they all saw the same thing, a pattern, a signal. a warning. And by 11 p.m. Eastern, when the New York markets closed, silver had not corrected. It had not reverted to mean. It had not obeyed the 247-year relationship with the dollar. It held because the smart money understood something that would take days or weeks for the general public to realize. When planes stop flying for reasons the government will not explain, and when metals critical to national defense start behaving like safe haven assets, the rules of the game have changed. And the question every business owner, every entrepreneur, every person responsible for protecting capital needs to ask is, what else are they not telling us? There's a photograph that hangs in the Chicago Mercantile Exchange, black and white, dated September 12, 2001. It shows a trading floor completely empty, chairs pushed back, computer screens still glowing, coffee cups half full, because the day before, at 8:46 a.m., the planes hit, and by 9:03 a.m., every exchange in America had shut down. But here is what the photograph does not show. What happened in the 18 hours before those markets reopened? A 72-year-old portfolio manager named Richard Steinberg, a man who had survived the 1973 oil crisis, the 1987 Black Monday crash, and the long-term capital management collapse of 1998, sat in his Manhattan office that night watching gold prices on offshore exchanges. Gold was trading at $271 per ounce on September 10th. By September 12th, when U.S. markets finally opened, it had jumped to $287, a 6% move in less than 48 hours. But Steinberg was not watching the price. He was watching who was buying. Central banks, sovereign wealth funds, family offices managing generational wealth. They were not panic buying. They were methodically accumulating because they understood something that took the general public years to realize. When civilian airspace shuts down without warning, when the mechanisms of normal commerce freeze, when the infrastructure of daily life stops functioning, the first instinct of institutional capital is not to sell. It is to convert paper wealth into physical assets. This is the pattern. This is the precedent. And it has repeated again and again and again. Fast forward to March 2020. The world locks down, flights cancel, borders close, and while retail investors are panic selling everything they own, driving the S&P 500 down 34% in 33 days, something else is happening in the precious metals market. Gold goes from $1,500 per ounce to $1,700. Silver climbs from $12 to $18. In the middle of the worst equity market collapse since the Great Depression, metals are rising. Why? Because the professional money managers, the pension fund strategists, the endowment allocators, they are not reacting to today's headlines. They are calculating tomorrow's consequences. They see governments printing trillions of dollars. They see central banks buying corporate bonds for the first time in history. They see the boundaries between fiscal policy and monetary policy dissolving. And they know, from studying every previous crisis, that when governments choose inflation over default, hard assets outperform paper assets. It is not speculation. It is historical probability. But the pattern goes back even further. August 15th, 1971, President Richard Nixon appears on national television, 9 p.m. Eastern Time, prime time Sunday night, and he announces that the United States will no longer convert dollars into gold. The gold window closes permanently. For the first time in human history, the world's reserve currency is backed by nothing except trust in the government that prints it. Gold was trading at $35 per ounce that morning. By the end of the decade, it hit $850, a 2,400% increase. But here is what most people miss when they study that event. The smart money did not wait for gold to hit $800. They moved in August 1971. They understood that when the fundamental architecture of the monetary system changes, when the rules that governed wealth preservation for centuries get rewritten overnight, early positioning is everything. Time lag, that is the critical variable in every one of these events. The time between when institutional capital recognizes a paradigm shift and when the general public figures it out. September 2001, that lag was 18 hours. March 2020, it was 3 weeks. August 1971, it was 9 years. And in every single case, the wealth transfer happened during the lag. While newspapers were printing headlines about terrorism, or pandemics, or economic policy, the real story was happening in the order flow, in the futures pits, in the physical delivery requests at bullion banks, in the quiet accumulation patterns of people who manage serious capital for a living. They were not trading on fear, they were trading on mathematics, on probability, on the understanding that certain events, certain policy decisions, certain moments when civilian infrastructure stops functioning for unexplained reasons, these moments have consequences that play out over months and years, not hours and days. And now, February 11th, 2026, Planes grounded over Texas. Silver holding above $84 while the dollar climbs. The pattern is repeating. The precedent is active. The time lag has begun. And the question is not whether institutional money is positioning. The question is, how long before everyone else figures out what they already know? There's a man named David Chen. He works on the 19th floor of a building in Lower Manhattan. His title is Senior Risk Analyst for a pension fund that manages $43 billion. And on the evening of February 11th, 2026, at 7:16 p.m., exactly 13 minutes after the FAA ground stop, he received a phone call from the fund's chief investment officer. The conversation lasted 90 seconds. No pleasantries, no small talk, just 4 words. Check the COMEX spreads. Chen pulled up his terminal, and what he saw made him reach for his second monitor, then his third, because the numbers on his screen were telling a story that did not match the official narrative. The spread between physical silver delivery contracts and cash-settled futures had widened to levels he had only seen twice before. Once in March 2020, and once in September 2008. Both times, within 6 months, the financial system had experienced what regulators politely call severe stress events. What Chen was looking at was not a price, it was a warning signal. The COMEX, the New York Commodities Exchange, is where the global price of silver gets determined. But here is what most people do not understand about how that price actually forms. There are 2 types of silver contracts traded on the COMEX: physical delivery contracts, where actual metal must change hands, and cash-settled futures, where traders simply bet on price movements without ever touching real silver. For every 1 ounce of physical silver sitting in COMEX warehouses, there are approximately 67 ounces worth of paper claims. 67. This is called leverage, and it works perfectly fine, as long as everyone agrees to play the same game. As long as traders are content to settle in cash, as long as nobody actually demands physical delivery. But when something changes, when trust in paper contracts starts to crack, when institutional players begin requesting actual metal instead of accepting cash settlements, the mechanism breaks. And that is exactly what Chen was watching happen in real time. Between 7:30 p.m. and 8:15 p.m. on February 11th, physical delivery requests on silver contracts jumped 340% above the monthly average. Someone, or more likely several very large someones, were not interested in betting on silver prices. They wanted the actual metal. Now, to understand why this matters, you have to understand what silver actually is in the modern economy. It is not just a precious metal, it is an industrial necessity. Every single smartphone manufactured contains 0.02 ounces of silver in its circuitry. Every electric vehicle battery requires between 1 and 2 ounces. Every solar panel, between 20 and 30 grams. Every cruise missile guidance system, silver conductors. Every 5G cell tower, silver components. The global push toward electrification, toward renewable energy, toward advanced defense systems. All of it depends on a metal that is becoming harder to source every quarter. And here is where the mechanism gets dangerous. Annual silver mining production, approximately 830 million ounces. Annual industrial demand, approximately 650 million ounces. That leaves a surplus of 180 million ounces for investment, jewelry, and strategic reserves, except the paper contracts on the COMEX represent 290 million ounces in short positions. This means there are institutions betting against silver in quantities that exceed the entire available surplus. If even a fraction of those short positions had to be closed by purchasing physical metal, there's not enough supply. This is the mechanism. This is the structural weakness. And when the FAA grounds planes for special security reasons, on the same night that physical delivery requests spike 340%, professional risk managers like David Chen start running scenarios. What if this is a supply chain disruption? What if critical infrastructure is being repositioned? What if strategic reserves are being quietly accumulated? What if the paper market and the physical market are about to decouple completely? By 9:30 p.m., Chen had drafted a memo to the fund's investment committee. Subject line: recommend immediate review of commodity exposure and counterparty risk in precious metals derivatives. He was not recommending panic. He was recommending awareness, because in his 23 years managing institutional risk, he had learned one fundamental truth. Markets can remain irrational longer than you can remain solvent. But when correlation patterns that have held for centuries break, when paper markets and physical markets stop agreeing on price, when the mechanism itself shows stress fractures, the time to adjust positioning is not after the crisis becomes obvious. It is during the quiet hours when most people are not paying attention. Between 7:03 p.m. and 11 p.m. on February 11th, while news anchors were discussing weather patterns and flight delays, While social media was speculating about military exercises, while the general public was checking flight status apps, the professionals were doing something different. They were calculating, positioning, hedging, not because they knew what was coming, but because they understood the mechanism. And they knew when the mechanism shows cracks, everything built on top of it becomes unstable. There's a family in Ohio, 3 generations running a manufacturing business that makes electrical components, started in 1987 by a man named Thomas Blackwell, passed to his daughter Sarah in 2009. And now, in 2026, Sarah's son Michael handles procurement. On February 12th, 2026, the morning after the Texas ground stop, Michael received an email from their primary silver supplier. Subject line, price adjustment notice, effective immediately. Silver component costs, up 18%. Delivery timelines, extended from 3 weeks to 7 weeks. Minimum order quantities, doubled. Michael forwarded the email to his mother. Her response was 3 words, call the accountant. Because Sarah Blackwell understood something that many business owners learn too late. When commodity markets start behaving erratically, when supply chains show stress, when prices move independent of normal market forces, the businesses that survive are not the ones with the best products. They are the ones who adapted their strategy before everyone else figured out the game had changed. This is not about predicting the future. This is about understanding probability. When planes stop flying for unexplained reasons, when metals critical to industrial production break historical correlation patterns, when institutional capital starts moving before headlines justify the movement, business leaders face 3 possible scenarios. Scenario 1, isolated event. The Texas ground stop was routine security theater. Silver prices mean revert within weeks. Supply chains stabilize. Business continues as normal. Probability based on historical precedent, roughly 15%. Scenario 2, early indicator. The ground stop signals broader systemic stress. Commodity volatility increases, but the fundamental system holds. Businesses adjust pricing and inventory strategies, but maintain current operations. Probability, approximately 50%. Scenario 3, paradigm shift. The correlation break represents a fundamental change in how capital flows during uncertainty. The relationship between paper assets and physical assets is restructuring. Businesses must rethink treasury strategy, supplier relationships, and capital allocation from the ground up. Probability, 35%. Now, here is what separates strategic thinking from gambling. You do not bet everything on one scenario. You position for all 3. For the Blackwell family business, this meant 3 immediate decisions. 1, lock in silver component prices for the next 6 months, even if it required paying a premium today. 2, diversify supplier relationships to include domestic sources, even if per unit costs were higher. 3, review customer contracts to ensure price adjustment mechanisms were in place for commodity volatility, not panic, not speculation, just basic risk management based on observable market behavior. But the implications go deeper than procurement strategy. For entrepreneurs building new businesses, the question becomes, what thrives when correlations break? History provides clear answers. Businesses that solve supply chain problems, businesses that provide alternatives to centralized systems, businesses that help other businesses manage commodity exposure, businesses that facilitate transactions when traditional banking relationships become complicated. These are not get-rich-quick schemes. These are structural opportunities that emerge when the architecture of commerce shifts. In 1971, when Nixon closed the gold window, a handful of entrepreneurs recognized that currency volatility was about to become permanent. They built foreign exchange trading platforms, commodity hedging services, international payment systems. Businesses that did not exist in 1970 became billion-dollar industries by 1980. In 2001, after the planes hit, after civilian airspace became a security variable instead of an economic constant, entire industries emerged around supply chain resilience, distributed operations, redundant systems. In 2020, when the world locked down, businesses that could operate remotely, deliver digitally, function without physical proximity, they did not just survive, they redefined their industries. And now, February 2026, the pattern is active again. But this time, the commodity involved is not just a store value, it is the conductive backbone of every technology the modern economy depends on. Semiconductors, solar, batteries, defense, telecommunications, all of it requires silver. And when physical inventories hit 12-year lows while paper contracts represent leverage ratios that cannot be sustained, when institutional money starts demanding delivery instead of accepting cash settlement, when the FAA grounds planes and offers no explanation beyond 3 words, the business leaders who understand what is happening are not asking whether to adjust. They are asking how fast they can reposition before the lag time closes. Because in every historical precedent, from 1971 to 2001 to 2020, the wealth transfer happened during the lag. The opportunity existed in the gap between when professionals recognized the shift and when the general public caught up. That gap is measured in weeks, sometimes months, never years. And the February 11th event is not the end of a story. It is the beginning of a question every business owner must answer for themselves. When the mechanisms that governed commerce for decades start showing cracks, when the correlations that determined asset prices for centuries suddenly break, when the people managing billions of dollars start positioning differently than they did the month before. Do you wait for certainty, or do you act on probability? Because certainty only arrives after the opportunity has passed.